I will do that. And part of this is conjecture, so you're going to have to realize that it's my best opinion. Not all of this will be fact, but I've certainly looked at it pretty hard, probably harder than most people. And it's my understanding that early on, one of the brokers for the Hunts were telling them, I think in their home, about the merits of silver investing. Now, whether or not they had read my predecessor's book, Silver Profits in the 70s by Jerome Smith or not, I don't know. Perhaps the broker had, perhaps the Hunts had. But Jerome had made a very strong case for the silver market from a long-term investment point of view. Regardless, they were introduced to silver as an investment, and they, I'm sure, did their own homework. And so they started investing in silver in two ways, actually. I'm sure there were more than two. They're really in three ways. They did it in the physical market, they did it in the futures market, and they did it in the mining industry. And it built and built and built over time, and they got to the point where they had a great deal of physical, but they also had a great deal on futures, as well as a lot of situations in different mining deals throughout Canada and the United States. So certainly they were probably the biggest silver bugs the planet's ever seen so far anyway. And what happened was that one of the people that actually ran part of the exchange was short silver. So from my opinion, this was a conflict of interest. You can't have somebody that actually works for the exchange and be, long or short any futures market. He should be neutral. You can watch him, but he shouldn't really participate. Regardless, what happened was the silver price got into a short squeeze situation where the amount of demand on silver was much greater than the current supply, and the market started to move higher and higher very rapidly. Now, this happened at the end of the market. I want to be clear that certainly I've said again and again and again that silver's hit $50 the ounce, and it has. But the amount of time that it traded above, say, $25 the ounce is, for the record, very short amount of time, very short. So this is a spike high for silver and a spike high for gold at 875. This isn't like the average price. And it wasn't like you could get out at the top of the market. Very, very few got out at the top of the market. Coming back to the question, silver. So as this price skyrocketed higher, it got to a point where the exchange said you could no longer put in any buy orders whatsoever, only sell orders. And once that took place, then the market crashed. It went down substantially. And many people talk about the rule change, that the commission changed the rules. And I won't argue that statement. What I will say is fast forward to maybe 8 years ago. And Phil Baker of Hecla Mining put together a silver gathering, I'll call it, in Spokane, Washington. And he brought in some of the major silver mining companies. He brought in the CFTC, the Silver Users Association, CPM Group, the Silver Institute, myself, that basically comprised most of the meeting. I might have left someone out, and forgive me if I have. And we had this meeting, and we got to hear all points of view. We got to hear my point of view, the point of view from CPM Group out of New York, the Silver Institute, the Silver Users, and the CFTC. And the gentleman from the CFTC said something that's always stayed with me. He said that during the Hunt situation, that they never changed the rules, that they merely enforced the rules that were already in place. Now, I can't go back and look at what it actually said, but I have read what the current rules are. And the exchange can do almost anything they choose to do. For example, if there were to be another silver squeeze on the futures market in silver, the exchange could stop trading. They could make you settle for cash. They could actually close down the exchange. So several things are already built into rules right now. So anyone that's in the futures market, that's fine with me. I do myself. But I've always taught from the beginning, and will continue to do so, that to start a precious metals portfolio, you must start with the physical metal itself. And Hunt did that. Coming back to Hunt, he took a great deal of physical metal, and actually at one point on one of his deliveries, the exchange could not meet his demand of bars, of commercial grade, 1,000 ounce, 999 fine silver bars. But they asked him if he would substitute silver bags instead of bars for the equivalent amount of silver. And he said, certainly that's okay. So he's being a nice guy. But actually earlier, before the big event, He could have squeezed them a little bit had he wanted to, but at the time he was being nice. And I also want to address that slightly as well. And this is off topic, but I think it's important to know that when I started looking at the silver market very closely, there were two silver markets on the futures exchange. There was a bullion market and there was a bag market, because the silver coinage in the United States up through 1964 was 90% silver. And there was so much coinage around that you could actually get in the bar market or the bag market. And there was some arbitrage going on between the two. You might get a better deal on one side or the other, so there's a lot of arbing going on between it. Well, that left, the bag market left, and the reason the bag market left was a lot of those coins had been melted into bars. And that hasn't existed for years and years, but you'd have to be a silver bug like me to even know that at this point in time, but that did exist. So what I'm pointing out is that actually the silver market for coin bags, and there's still some coin bags around, but it's not vast enough or big enough to have a futures market behind it.